Welcome to today's Thursday session. It is the 7th of August 2025, and we are looking at another presentation on psychology titled The Complete Turtle Trader. We are actually looking at a book, just summarizing what the book contains and some of the lessons that we can draw from that. And that book was by Michael Colville. So this was a study of how 23 newbies or novices were transformed into millionaire traders through a revolutionary experiment in systematic trading. Those who are interested in this book, you may go and search for The Complete Turtle Trader by Michael Colville. That is the author of the book that we are working with today. Okay, so what they did, we just give a summary of the story and then look at the key lessons. What happened was there was an experiment in which Richard Dennis and William Eckert conducted an experiment to try and settle a debate. Richard Dennis believed that trading could be taught, whereas William believed that it could be an innate talent. It is something that you are born with. You are either a trader or you are not. So to prove this, they got into the challenge whereby they looked for 23 people with no trading experience at all. These people were trained in 2 weeks, and many of them eventually became millionaires, as we are going to learn as the story goes. This is there in the book. You can also refer to that one, which can then provide some substantial information on the detailed explanation of what happened. So the big idea that was there was that the turtle experiment proved that with the right rules and mindset, virtually anyone can become a successful trader. Why? Because they just picked random people. Some were game designers, some were working in security. People came from different walks of life. And all of these people were trained to become traders, and they actually got successful such that they made millions. So it proved that virtually anyone can become a successful trader, but there are rules that should be there. And these are some of the rules that we want to look at here. The first one is systematic approach. So what this concluded was that trading can be taught using a rules-based system that eliminates guesswork and emotional decision making. So in other words, if you have a systematic approach, the likelihood of you being successful, especially if the approach that you're following is successful or is proven to be successful over time, the chances of success are high. What they also learned was that trend following works. That is when properly executed, systematic trend following produces consistent results over time across various market conditions. It also proved that psychology matters most. So the actual difference between successful and unsuccessful traders is not their system, but their discipline and psychological fortitude. This is to be covered shortly. So, what was the turtle methodology? They had rules versus discretion. The turtles, and by the turtles, we're referring to the people who appointed those 23 individuals. He decided to call them turtles because of the way they were implementing things. He had been at some conservation area where they were actually raising turtles and keeping them, and he just then coined a name for them to be turtles. But the turtles followed precise rules that eliminated subjective decision making. This is important. One of the key insights that came here is that the power of the turtle system came from removing emotions and following the system regardless of personal opinions about market direction. So it's mainly not about your personal opinion or intuition. it is more of you removing all emotions from a system and following such a mechanical system which has already made decisions for you based on it itself. Entry signals, for example, they used to look at precise breakout levels which determined when to enter a trade. There was no intuition or predictions allowed. So they were more of reactive to the market, that is to wait until something has happened and then they actually then execute based on that information. Position sizing, they used exact formulas based on market volatility, which determined how much to trade at a given point in time. There was risk management, strict stop losses, and exposure limits, which protected capital, as well as exit strategies, that is to say, mechanical rules which dictated when to take profits or cut losses. Some of the core trading principles that they had, they followed long-term trends, that is to capture major market moves by following directional trends that develop over weeks or months. So this is basically following the longer term time frame or the higher time frame to try and see what the prevailing trend is and then trading in line with the prevailing trend. They use breakout strategies, that is to enter when price breaks through significant support and resistance levels, signaling potential trend continuation. They would limit their risk per trade to only 1 to 2% of capital on any single position to survive inevitable losses. This was also important because the moment you risk less of your capital on a single trade, it enables you to live to trade another day. And this is what actually keeps a trader in the game for long, or what actually determines that you are part of the 95% who lose money. They would also diversify markets, that is to trade across multiple uncorrelated markets, that is to reduce the overall portfolio volatility. So this system worked because it was comprehensive. It covered every aspect of the trading process. If you look at these four things, long-term trends, that is to say market direction. You need to consider market direction. You need to know where the market is going as far as long-term is concerned. Breakout strategies, that is just basically an entry strategy. Something that actually confirms for you how or when to enter. Limiting risk per trade, that is risk management. Risking only 1 to 2% of capital to try and preserve and to live longer. And then diversification of markets, not putting your eggs in one basket to ensure that you reduce your exposure and you also reduce the overall portfolio volatility. So this covered every aspect of trading itself. And then their secret weapon was risk management. Position sizing was based on volatility. So the turtles used N, that is the average true range, to calculate position size, whereby if they experienced more volatile markets, they would use smaller positions, and for less volatile markets, they would use larger positions. This equalized risk across all trades regardless of the market that is being traded. Also, there were risk control mechanisms such as unit system for scaling positions, maximum exposure limits per market. That is to say, if you are trading gold, you tell yourself, I cannot be exposed to this much in terms of monetary value. Predetermined stop losses on every trade. So these are some of the things that they would follow, which then guaranteed success. According to Richard Dennis himself, the turtle trading creator, he has this quote that he also has in the book, which says, you must learn to lose. It is more important than learning to win. So that is also something that's important to take note of. But at the end of the day, psychological discipline was one of those things that were a true differentiator. You find that mindset ultimately mattered more than market cause or analysis. So we've got something known as emotional control, whereby the successful turtles had mastered their emotions, especially the fear and greed that led to breaking rules. Mind you, they were trading with Richard Dennis's money. He trained them and taught them how to trade based on a systematic strategy. He then funded them with his own money Some were managing $100,000, some $150,000, etc. But at the end of the period at which they were looking at, most of them were already millionaires, having grown their accounts into the millions because they had mastered emotional control. They were consistent, that is, they followed a system even during prolonged losing streaks, and knowing that eventually the math would then work in their favor. So, this then speaks to people who are always worried about, a couple of trades that you take, who are playing the short term game instead of the long play. It is good to know that if you have a proven strategy, one that you know that eventually from backtesting and historical data, and you've done your due diligence in setting it up, that in the long run it will eventually pay off and the math works in your favor. They were also good at accepting losses, that is to say, they understood that losses are normal parts of any profitable trading system and not failures. So, with these three, emotional control, consistency, and loss acceptance, they were good enough to then establish a sound psychological discipline, which then was the true differentiator that actually proved the success of these turtles. So, the power of simplicity is something that is also important that we learned from this story as well. The turtle system was very simple, mind you. You might think that it was something complex. It was not. They had entry signals which were a 20-day price breakout to a highest high. They had an exit signal which was the 10-day price breakout to lowest low. They had nothing complex. They had no economic analysis or market predictions. All they did was follow a systematic strategy. And the turtles proved that complexity doesn't equal profitability. Their system worked because it was simple enough to follow consistently and not because it was sophisticated. This is another lesson that we can draw. It's not about how sophisticated your strategy is. It just has to be simple enough and effective and consistent, such that it has provided results for you in the past. It can provide results for you even up to now, and it's something that you can work with on a consistent basis. The long-term thinking is to then let winners run. This is in conclusion. You find that the market is very volatile and a lot is happening, and what we experience is just the tip of the iceberg, which is short-term noise. We also have daily price fluctuations, but the things that are actually then important for you to be long-term or to stay in the game for the longest time is to then also have these other characteristics, such as controlling your emotional reactions, your long-term principles, as well as having patience and trust in the system that you have backtested well and set for yourself. The patience principle says staying in winning trades can actually result in great profits. These turtles would stay in winning trades for weeks, even for months. They accepted significant drawdowns as part of the process, and they focus on long-term performance and not daily P&L. So the lesson that we draw from this is to let the profits run and cut losses fast. This might sound counterintuitive, but it allowed the turtles to capture the rare but massive trending moves that then generated outsized returns. So for today's trader, what can you do learning from this book? Of course, this is just a summary. You can then read the entire book to get very solid knowledge. Like, that book is one of the best books that you can read as a trader to try and follow or just learn one or two things about trading itself. So for today's traders, building your own system is key. You need to develop a clear objective rules for entries, exits, position sizing, and risk management. You need to test your system thoroughly. That is to backtest your strategy across different market conditions to build confidence in its effectiveness. You need to focus on execution. That is to perfect your ability to follow your rules without deviation, and that's regardless of emotions or market noise. You also need to train your psychology. That is to develop